Welcome, everyone, to the Directed IRA podcast. If you've been wondering about how the heck you can self-direct your IRA and buy cool stuff, well, you got the right podcast.
Woo!
That
was one of your most to the point, good introductions. You just nailed it right there. Yeah.
It's the end of the day today when we're recording, and I just want to cut to the chase.
Yeah, it's like you didn't pull any punches with that. Well, that was Matt Sorensen, the amazing CEO of Directed IRA, the most fastest growing, highest customer service rated directed trust company in the country. How was that?
Yeah, that's all accurate.
All right.
All accurate. Yep. We're the best. We're the best. I don't want to say what we do with excellence. You know, there's this little salty, but well, I'll say, Ricky Bobby, I just piss excellence. I'm the best. That's all there is to it.
Show me second place and show me a loser.
Yeah.
Now I am the measly CFO of the Directed Trust Company, but we are also both senior partners, equally yoked in the KKOS law firm. Been around for 20 years, been helping clients with their small businesses and building their retirement accounts for 20 years. We love this space. We finally got around to a podcast on it just this year because we're like, you know what? We got to get some more info out there, not taking a shot at anyone else out there in the space, just trying to be the best we can and deal with it. That's it.
Yeah.
Is that okay?
And if you don't like the podcast, we do give full refunds. Whatever you've paid, if you don't like it, 100% refund.
Yeah, we'll hook you up. All right. I'm also a CPA. Matt's a tax attorney, and we're here for you. And Matt, tell us the topic today. I like it.
Yeah, this is cool. We're going to talk about investing in a private company, private fund, or small business with your IRA. If you've listened so far to the podcast, you know anything about self-directed IRAs, you don't just have to buy the big publicly traded companies. You know that you can invest on Main Street. You can buy a small business. You can invest in a private fund.
Would that be
that's stuff we're going to talk about today?
Yeah. And I was going to ask, would private equity?
Yeah. Private equity fund.
A PPM?
A PPM, private placement memorandum, a hedge fund. You could do a private REIT. We have clients that have done those. An LLC or limited partnership real estate fund. That could be a private placement real estate fund. Okay. Now, there's other things you can do. There's ways your retirement account can own a business that you're kind of setting up. But we're going to do that in another podcast. We're talking about, you just want to invest in some other cool business. Yeah. You want to invest in the next Facebook. You want to invest in some private fund that's doing cool things and getting good returns.
Yeah.
That's what we're going to hit today.
I would say too, in this typical scenario, you are not a manager or an officer of this operation.
Right.
You would be generally considered a limited partner or a passive partner or an investor. If that term fits the shoe, wear it. And because we're normally, and we've talked about this for years, we want to be careful of throwing the investor word out there. Because if you're out there raising money, you got to meet with a lot of requirements if you're going to call people investors. Well, a lot of these private equities and hedge funds and PPM, they've done that. They're legit. Yeah. And so you are an investor. So that's okay. But you're not an officer or director of these businesses.
Right. Exactly. And so let's focus on how you can use your retirement account to do this, because it's kind of cool. And I want to give a few examples. Okay.
Let's start with a cool example before we get into tech.
Okay. Let's start with, I'm going to start with an easy example.
Okay.
Pandemic hit. There was a bar and restaurant owner. Also had some gentlemen's clubs, just saying, that was part of it. Okay. And those shut down. Okay. They got shut down in the pandemic. Okay. I had a client's IRA come in, buy up some shares in that business, gave them an influx of cash for that to help them get through the pandemic. Knew this business had been around for 20 plus years before. They were friends and said, hey, I just want to invest in your small business. And this was an existing business. Okay. So we see that. We see transactions like that of, I'm going to buy some stock in your small business. And we're going to talk about how you do that. But that'd be an easy example.
Okay.
Existing
now,
business.
If I can play off that example, that would not be a private equity, registered security scenario. That was a buddy, and this is very, very common and very okay. is your friend down the street says, I've got this business, I'm struggling right now, or I want to expand. It couldn't be, maybe it's not a crisis, but an opportunity. And they come to you and say, hey, do you want to buy in? Now, guys, gals, this is what we talk to our clients about all the time. It's called opportunity shifting. When that person comes to you and says, hey, do you want to buy in? You say, no, I don't want to buy in, but my retirement account does.
Yeah.
That's the difference. And you have to use that nomenclature, that verbiage. You got to remember, this is not you. This is your retirement account. And so clients come to me, especially I'm kind of the more tax planner. I'm on podcasts or webinars or lives all the time. And people are like, how do I save taxes? I'll say, quit making money. Let your retirement account make the money.
Mm-hmm.
And that's the difference here. In this wonderful example is this friend down the street said, I need some cash. And he's going to, and let's just talk particulars. You'd probably say, here's my operating agreement. Go look at it with your lawyer. What would happen next?
Yeah. Yeah. So, okay. So the first thing you want to do is you want to understand, well, what type of business is this? Is this an LLC? Is it an S-Corp? Is it a C corporation? Those are going to be your typical 3 businesses out there in the small business world. One of those is a problem. All right. So let's walk through that. Okay. The first one, S corporation. If the person has an S corporation or the business is an S corporation, your IRA will not qualify to invest in it. IRAs just can't buy stock of an S corporation. Now, your IRA could loan them money. You could be a lender to an S corporation and maybe get a lien on some assets the business owns, but you can't buy the stock in an S corporation.
Now, I got a backup plan, but go to the LLC and C Corp, and then let's circle back. So,
okay, the next would be the C Corp. The C Corp is pretty easy. That's basically when your IRA is buying Microsoft or Apple or General Motors, if anyone buys that stock anymore. When your IRA is buying those are C Corps, okay? Straightforward, IRA owns it. There's nothing called UBIT tax you need to worry about. And you're in business, you own some of the stock.
And typically in that situation, your friend is not going to have a C Corp. That's screwy, not typical, but they could have the LLC. Is that okay?
Yeah. Now let me say on the C Corp, we see that a lot in the startups. So when you're investing in a startup, that could be the next big thing. And there's tons of these going on right now. Those are typically going to be C Corps.
Okay.
So you're usually good there, but the existing small business down the street is going to be an S Corp or an LLC.
Okay. And the LLC?
Now here's the way you need to, when you're investing in an LLC, your IRA can own an LLC. You're going to be what's called a member of an LLC. That's like shareholder of a corporation. You're called a member in an LLC. You're the owner. You'll negotiate whatever percent you can out of that, right? So think of this bar and restaurant that was shut down, needed an influx of cash. Was that, if you're the retirement account investor, you're like, can I get 20% ownership out of this for my 250 grand? What's the business worth? And so you got to negotiate that. In this example, they negotiated a buyout so that the existing business owner could buy the IRA back out, but it was for like a 3-time multiple. Ooh. So the only way they could force him back out to buy him back out was at a 3-time return. So if I put in 250, that'd pay me 750 to get me back out. Yeah. To force me. I could always sell, if I wanted to sell, but to force me back out.
Okay.
So, and you can negotiate terms like that. Now, the LLC, one thing you need to know what these operating businesses.
Well, hold on. Before you go there, Matt, I know where you're going, and I think that's going to take us to another level. I kind of like to dumb things down a little bit. Matt's so smart. I'm the dumb guy, so it helps. Now, in that, after the negotiation step, typically, this is where people screw up all the time. I don't know why, because they've got their retirement account and their due diligent brain just is gone, or because if I was going to go invest in this restaurant, for some reason, I don't know why people in that situation are much more diligent to go in and look at the books and negotiate a good membership transfer agreement and look at non-competes and all these things. People they think it's their IRA, so they throw a little more caution to the wind. You don't want to do that. Step 1's negotiating. Step 2 is making sure that your retirement account, whether it's an IRA or 401k or whatever your retirement account is getting a good document, a good legal document. Get your lawyer involved. Your lawyer brain might explode. They'll be like, your retirement account's buying this? You can't just shut up and just look at the contract as if it was me. So don't let your attorney jack it up by getting freaked out that your retirement account's doing it. Call our law firm if you need it. But negotiate well, and then you're going to get a membership certificate and buy into the LLC. Matt, was that okay? I got a little upset.
There'll typically be a membership transfer agreement or purchase agreement to buy the units of the LLC. In this small business case, you're going to get added on to the operating agreement of the LLC generally, when you're going to have to know what the operating agreement is. And you want to know that. Yeah. Do I have any voting power now if I'm an owner? What if I have voting rights, but I only own 40% of this company and the person I bought in with has 60? Do I have a say of anything? Probably not. You know, you got to negotiate that stuff. And you want to have that control, because you're going to be able to vote for your IRA in its position to say, yeah, we should take on debt. Yes, we should open a second location, you know, whatever it may be in the business you're investing into.
And we're going to come to the private equities. Hang out, everybody. But let's think through this a little more. See, hopefully we're opening your eyes to, okay, it's just like me buying into a business, and I got to negotiate on behalf of my IRA or 401k. I got to negotiate properly. I got to make sure the documents are done properly. Do I have a voting right? And again, in this situation, you're not going to go bartend. You're not going to go run the books. You're not going to go run the show. Now, can you go patron the gentleman's club or the restaurant? Sure. But you're going to pay the same fees as everybody else because you're not an owner.
Yeah.
The retirement account is. So you're going to negotiate. And when this deal goes down, you want to talk about, where's the money going to go? See, a lot of times in a business sale, the money is going to go to the person selling the membership or the stock. Not in this situation, I suspect. You said, okay, if I'm going to put this money, I want the money to go in the business. So now the accountants have to be involved, because you don't want a capital gain for the seller. You want an infusion of cash going into the business, so it's not a taxable transaction for the other owner.
Right.
And accountants have to account for that differently on the tax return of the seller and the buyer. So these are little things you need to deal with. And if you're going to spend a couple grand in legal or accounting, it's okay. Yeah. This guy got a killer deal, it sounds like.
Yeah, that would be like, you know, the non-planning of, I'll just transfer half of my ownership and I just got a capital gain, instead of just selling new units and diluting yourself to 50% or whatever the negotiation is.
And Matt, how many times does that happen? People just
see that.
Send money over here. You're like, what are you getting? Well, I'm just buying part of this company. Well, where's the contract? Well, here's a napkin from Denny's. No. Oh my gosh, it drives me insane.
So
private equity example. Give us a good private equity example.
Okay, let's talk about private equity.
Oh no, I said the S-Corp thing though. We were going to circle back, weren't we?
Well, UBIT. Well, we got to talk about UBIT actually, because the S-Corp. Yeah.
Let me just say the S-Corp thing, because normally a restaurant owner like that is going to be an S-Corp. And you don't want a dumb accountant or lawyer to torpedo you buying in. So typically in this, we do, in our firm, we call it a reorganization. So what you would do is create an LLC, and you would inject your retirement account money as a 40% owner, in Matt's example, and the current owner would buy or contribute the assets of the business through his S-Corp as a 60% owner. So you end up with this new parent that would own and operate the business, and your retirement account would own part of that LLC, and the current owner's S-Corp would own the 60%. So it's doable. You just need good accountants and lawyers to bring it together. And it's not terribly expensive. So don't think you're out of the cold if someone comes to you and says, you want to buy into my business? I got an S-Corp. No, I can't. My retirement account can't own an S-Corp. No, we just reorg it and backdoor you in.
Yep. Well, love that. I didn't even think of that. That was great. I just skipped that.
Thank you.
I love it.
Yeah, that's why we're partners.
I know. You know, such a good team.
Okay. Now, Matt, before you go to UBIT, let's get the private equity people in the mix. Is that okay?
Let's just call it the private fund. Let's just call it the private fund account.
Okay. Private.
Because this could be a hedge fund, a private equity fund, you
PPM.
know. Yeah. Any type of PPM.
Limited partnership.
Yeah. And that's, And so, so that structure is basically you have someone who's raising money for investment purposes. They're going to go out and buy and sell stock or do real estate deals or buy and sell small and medium-sized businesses if they're like a private equity fund.
You got a prospectus.
Yeah, there's a prospectus or an offering document. And what you're doing in those is those people raising the money have a management team that run the fund, that make decisions, that get a management fee. They get a share of profits when the fund makes money. Then they push down the rest of the profits, of course, to the investors.
Yeah. And it's good.
So,
That's okay. It's great.
Yeah, very common. And that's, like there's lots of famous, hedge funds out there, for example, that are like very exclusive, and who gets in is like, you've got to like know the right people and kiss the butts or whatever to get in. Now there's a number of funds out there that are actually very famous that have had ridiculous returns over the years, that we have a couple clients that are in some of these funds that you can't just call up and be like, I want to buy in. Even if you're like, I got $1 million, can I buy into this fund? They'll be like, nope. But you gotta like know someone, unfortunately. So now there's those types of funds, and you can't even with those types of funds that are like very well known, but super exclusive. They're not publicly traded. Okay. These are private funds, and they're usually under what's called Reg D under the securities rules. Your IRA can just invest in those. And of course you can open an account at Directed IRA to do it. Now you have the regular fund too, that might just have 100 investors in it, and someone's just out there raising kind of a smaller fund and trying to raise maybe 10 million bucks or 100 million or 5, whatever. Very, very common too.
Now, what's good about these types of deals is it's not John or Mary down the street. These have professional managers. They're going to have a track record of some sort. They have a prospectus. Yeah. And so the nice thing about this is you're generally going to have less stress, and there's not a lot of negotiation. It's a deal. Here's the deal.
Yeah.
You want in or do you want out? And their documents are going to be vetted 50 times over by all the attorneys involved.
Well, let me say this. What Mark's saying, it's your duty to make sure this is the case before you invest.
Yeah.
That you have all the documents. Yeah. You want to look at the management background. Okay. Just because you got an email from someone or somebody told you to invest, or you saw some workshop or something and they offer a fund, doesn't mean you should. You're
and
we're
not doing that for you either. The Directed IRA, that's on you. Just like your buddy down the street, you got to do your due diligence. But I would say, Matt, don't you? I mean, with these private funds, at least you're going to have something to look at that's a little more organized.
Right. Like the small business down the street, the bar or restaurant. I mean, you're going to have to kick the tires and like create the documents and get some financials out of the current owner, right? Yeah. The private fund they have a whole packet typically of documents that the SEC requires. You generally want to search to make sure their fund's registered at sec.gov. There's a search tool there. If this fund's big enough, and most of the private funds we see through here there's like some exceptions to it, but so there's definitely more preparation in the documentation. Now, someone could be a terrible fund manager and could lose your money, right? So you want to, of course, get to know the people that are running it, talk to other investors, do the typical due diligence things you would do. But it's a very popular world to be in right now in some of these private funds that are finding opportunities in the markets with all the volatility we've had.
Now, in both of these situations, correct me if I'm wrong, Matt, as CEO of Directed IRA, once you find the fund that you're cool with and you're stoked on, or buddy down the street and you vet him and you go over and look over his shoulder and or her shoulder, and you're looking at QuickBooks and you're happy, you're going to go to Directed IRA and go, hey, I opened my account here. I moved my money from my IRA or my 401k rollover or whatever it is. Your money's at Directed IRA. Now you're going to say, what form do I use to get this done? And there's going to be some specific forms that you'd fill out and submit so that we can do the deal and get that money where it's supposed to go. Is that a fair way of saying it?
Yep. You're going to do the direction of investment, private company, private fund. You tell us how much you want to invest from your account, attach the documents, authorize us to sign them and execute it. Money goes out in a couple of days, So now here's the critical thing on the docs.
Yeah.
Remember, you're not investing in this fund. Your IRA is. So the documents do not say Mark Kohler is the investor. It says Directed Trust Company, FBO, Mark Kohler IRA. All right. And you sign the documents read and approved to say, I approve you guys, Directed IRA, but we will actually sign for the IRA. And now let me hit one other note. Oh, turnaround time. Okay.
Yeah, be a little more clear on that if you don't mind. What should people expect process-wise? Because some people are like, can't you do this today? Or sort of thing.
Yeah, I'd probably say the average time is about 2 to 3 days turnaround time to fund it. Now, we're generally funding within a couple of days, 1 to 2 days, just because we're on our stuff. We got our crap together over here.
Once they submit everything.
Once you submit everything, right? Now, if
Okay.
you know what you're doing, we're going to process it fast. If it's your first one and you blow up the documents, you don't do it right, there might be some back and forth, but we're going to help you through the process. Our investment team is very well trained. We're doing a number of private funds every day. Like one I remember we did, this is a couple months ago now, was it was a men's health, medication. It's a medical company, had a lot of doctors involved, helping for men's health in the bedroom. Let's just say that. Okay. Trying to solve some problems there,
Well,
let's just say if it works, that is something people will pay money for. All right. Okay. All right.
Usually I'm the one getting in trouble. We've got a gentleman's club example and now men's health pill.
I should get better examples.
The ladies on the show are like, these guys are creeps. No.
Who are their customers over there? I know those. Why are those the funds that I remember? I just whoa, what's this one? Here's another cool one that came through though. A fund, a Netflix movie. So it's kind of a Netflix movie. It was somebody who's produced them before that's had stuff get on Netflix and purchased. And so we had some clients' IRAs investing in a fund that was you're buying shares in the company that's going to own this Netflix movie. You get a share of the royalties. And so that was cool. We see stuff like that in these funds as well.
Okay. Now, if I may say, what happens on day 2? All this is done and your money is now invested in this deal. You're going to have an account that you can view online and see, okay, my account's there. It's invested in X. And then do you get the money, Matt? Who gets any dividends or money? Are they going to send it to Matt Sorensen in your mailbox tomorrow or put it in your bank account?
No. So when you complete the documents for the fund, most of these funds are going to have a section that says, hey, where do we send any distributions or any dividends?
You're before distribution. I'm trying to say profits from this investment are not going to you, the person.
Oh, I know. That's what I'm saying. Yeah.
Oh, okay. I thought you were talking distribution step down.
Yeah. The funds call them distributions. So the fund is distributing proceeds out to the investors. Okay. So you call it a dividends or profits. So when the fund's cutting money out to the investors, there's a section in your documents when you say, hey, fund, I'm investing, called the subscription agreement, where you indicate where to send the money. Now, don't put your address and your name. You're going to put Directed Trust Company, FBO, Mark Kohler IRA, if it was Mark's. And then you're going to put our account number and information, which we provide you. It's on our forms and our staff will do it for you if you miss it. And that way we're going to receive the income into the IRA. Just like when your IRA owns Apple stock and Apple issues a dividend, they don't send you a check. They send it to your IRA. It gets into your Schwab account or wherever your IRA is at. So similar thing with the private funds. They're going to send the money back to us. It'll get deposited in cash in your account.
Yeah. Now and then you can look at your portal and go, oh, money showed up today. And there it is.
And a lot of private funds do quarterly distributions. Some of them do an annual.
Okay. Now,
some of them don't distribute at all. Some of them have kind of a lifespan of maybe it's a 7-year fund, like a private equity fund. And some of those, even VC venture capital funds, those are kind of like, we're not really distributing the money necessarily. We're going to keep it, invested and distribute at the end of our time period.
I like it. Now, where I thought Matt was going when he said distribution is, and Matt knew this, is that, well, now the money's in your IRA. How do you get it? The investor, the person. Well, that depends on what type of IRA you have. Is it a Roth? Is it a SEP? Is it a simple? Is it an IRA? Is it a covered L? Is it a 401k? What is it? Well, you may be young, you may be old, and that's a topic for another podcast on how to get money out of your retirement account after it's grown to $1 million, right? Whatever it is. So we'll talk about distributions from the retirement account to you. But what Matt was talking about was distributions from the fund to your retirement account. There's 2 steps. And because it's just like your IRA bought Apple stock, the money goes into your retirement account. And then someday you're going to call up and go, I'm ready for a distribution from my IRA. Well, cool. We have a process for that. That's another podcast. But is that fair to say?
Yep. Yeah, exactly. Right. So, and of course, that cash is just building up in your account and once you have enough more money, you make another investment in something else. And so, or if you're 59 and a half or older, you just can start pulling it out and you take a distribution from your retirement account to you personally. Now I want to say one other thing. I mentioned the subscription documents or subscription agreement. When you're investing in a private fund, that is the key document that's basically saying, all right, I've read all the due diligence documents. I want to invest. Here's how much money I want to give you. Here's where send the profits back or any dividend income. If the fund's making money, send it back to me here to my IRA. But there's also a section there where you're going to certify in a lot of these funds that you're an accredited investor. Any of these private funds, not all of them, but many of them require you to be what's called an accredited investor, which means as an individual, you have $1 million net worth, not including your home, the equity in your personal residence, or you make $250,000 annual income single or $350,000 annual income married. And so you can qualify either because you have high income or you have $1 million net worth. Now, if you personally qualify as an accredited investor, your IRA does. Okay. So in that subscription agreement, when you check, even though the document's done in your IRA's name, you're going to check, I'm an accredited investor because I have the net worth or I have the income.
Yeah, I like that. Because a lot of people go, well, am I saying my account is an accredited investor or me, the person? That question is on you, the person. Exactly. And that's the one box where it's not your retirement account. It is you behind your retirement account. Now, some people say, why do I have to do this? Why is this required? Well, this actually goes back to the 1933 and 34 Securities Act, when all these little grandmas lost their stock in the stock market crash of the 20s, and they started to impose this securities laws, and they've evolved over the years. And it started in 1933 and 1934. And what the SEC, Securities and Exchange Commission, has done is
that's not the Southeastern Conference where like Auburn and Alabama
that we all hate. Corey.
Isn't that the SEC? No,
Alabama's in the SEC, right? Oh, he said, sorry, I love real football. See, our producer here, kind of a crazy guy. He's here in the studio and he's a huge Alabama fan. Some may call, or a bandwagon fan of LSU or Alabama. Okay, sorry, LSU, whatever. Is that in the SEC? I don't even care. I watch. Anyway, okay, with no distractions here. So
why did I bring that up?
What the SEC does, the Securities and Exchange Commission, they're trying to protect the little people that don't have a lot of money to invest, and they're worried that they might lose everything they have on this one investment. And so the SEC has said, hey, if you're going to have a fund, in some situations, not everybody, so some of you may go, well, I never got asked that. Well, it depends on the fund. But in this fund, they say we need to have an accredited investors form signed. What they're trying to do is say, this person knows enough, and they've got enough money that they're not idiots, and they're only allowed to invest because we consider them to be a smarter or a more a substantiated investor. Is that fair to say? That's why it exists. So don't hate it. Just sign the dumb thing if you qualify, but don't lie. Don't lie.
Right.
Make sure you.
Yeah. Good advice. Okay. Now there's one other variety of the private fund out there called crowdfunding. Okay. All right. So we've had lots of clients' IRAs invest in crowdfunding. The last one I did just recently, a few days ago, was a client's IRA was investing into a video game. Okay. This video. I
thought you were going to give some other salacious examples. So, all right. Okay. You're okay with a video game. This wasn't like rated M.
It was a PG video game too. It wasn't even a,
Okay, good. Thank you.
Okay.
All right.
Yeah. But this was a video game company that has made many successful video games already. And that's one way they raise money. They crowdfund it amongst their fans to go do all the work to make it. And so these crowdfunding offerings can usually raise $1 million. That was actually just increased last month up to $5 million. So eventually crowdfunding offerings are going to be up to get $5 million. But these are clients, we've seen them invest $1,000, $2,000, $500 in these crowdfunding offerings through their IRAs. Many of them are using Roths because they're hoping these are going to be kind of the moonshot deals that could be big. But that's a crowdfunding offering. So, and it's going to have similar documents like a subscription we've talked about, and a similar process of how you're going to invest through the fund. And of course, the fund's going to send money back to your retirement account as there's profits or distributions to be made.
Okay, now I'm going to pose the question that Matt has been dying to get to. No, I'm just joking. Is when you invest in this little LLC down the street with the restaurant or these funds of any sort, you're typically going to get what's called a K1. This K1 tells you at the end of the year how much profit you made. Now you may say, well, I don't care. This is going into my retirement account. It's non-taxable because this is my IRA or this is my Roth or this is whatever. So the K1 goes to directed IRA. I don't care, whatever. Or should they care? Matt, what's this tax? You were going to call it the UBIT tax that we might need to worry about.
Yeah, unrelated business income tax, UBIT. Now, this is a tax that can apply to your IRA when it receives business income. Okay. So Mark mentioned a K1. When you're in a private fund, it's usually a limited partnership or LLC, okay? Or maybe it's the small business, the bar and restaurant that's an LLC, let's say. When you get a K1, it's going to tell you what type of income you received. Box 1 of the K1 is not the one you want. Box 1 is ordinary income. When an IRA gets ordinary income from box 1 on a K1, it's going to have to pay this tax called UBIT. And it's a 37% tax rate. Now, there's some strategies. We'll do a later podcast on UBIT and another tax called UDFI, but I just want to flag it here. And this is something, if you have a knowledgeable accountant or tax lawyer, that'll kind of walk you through it. So that's what to look out for. Now, the bar and restaurant is probably going to have it. Let's say the hedge fund out there, it may not have it. The private equity fund or even VC fund may not have it because they're going to be pushing through capital gain income.
Yeah. If I may, Matt, here a good example is the restaurant is an operational business.
Yeah.
And the congressional or the reason for this tax from a policy standpoint is the government said, hey, if you don't get taxed on this, it's not fair to the other restaurants in town. So you and John down the street need to pay taxes on this profit because it's ordinary business income and everybody needs to pay their fair share of tax when it's operational. But if you invest in a fund that's doing rental real estate, commercial real estate, some sort of drilling or natural resource mining or something, it's going to possibly and probably be passive. And so when it's creating rental income or capital gain income, the government says, okay, that's investment income. And so we want you to get a big number in box 1 or a big number in box 2 or 3. We want big numbers. You all want big numbers. But we want to understand that, well, if it's box 1, I might have to pay some tax or my retirement account might have to. Or if it's passive in box 2, 3, or 4, or 5, whatever, you're going to have passive income that's not subject to UBIT. Is that okay, Matt? Mm-hmm. That's kind of why that happens. And so when you're looking at funds, you may want to think, is this passive or is it operation? Am I buying into a bunch of Chick-fil-A's or am I buying into a commercial building?
Mm-hmm. Yeah.
The Netflix movie.
Yeah. The Netflix movie, the profits are royalties. So the income from that is royalty income, which is exempt from UBIT.
Love it. Right. Commercial real estate.
Commercial real estate, if you have debt on it, this is where the problem that causes this tax called UDFI. But that's only on the profits from the debt piece. A little complicated for today for what we want to hit. But so if you're buying a fund that's a commercial real estate fund that uses debt to buy assets, you'll have this type of UBIT, but it's because of the debt. You're getting rental income, which is exempt from UBIT, but there's this tax on it if the investment entity you're investing into uses debt to leverage their purchasing power of assets.
Okay.
So
what about land speculation?
Totally fine. Again, unless there's debt used. So these private funds, we want to look at, I'm generally looking at if I'm advising a client as Matt, the tax lawyer, like directed IRA, you're supposed to be looking at this, and any self-directed investors out there, it's on you to kind of know what's going on in these funds. Like we don't know what's going on. I mean, we're looking at paperwork. So you got to ask the questions. And even when I'm an attorney and I'm advising a client reviewing documents, I'm asking, a lot of times you can't tell from the documents. Mm-hmm. It's a real estate fund. They don't say that they're going to use debt. They say they might, but they don't say they are. Now, a lot of them are. Now, there are some funds out there in the real estate space, and Real Crowd is one of the companies they've been on our podcast, the Main Street Business Podcast. They're probably one of the biggest funders of private real estate deals online, doing like apartment buildings and commercial deals, Real Crowd. But they have a number of funds on there that are no debt funds, that the people who do the real estate deals, they use all cash, and they really attract a lot of IRA investors. So sometimes you can look for specific funds if you're into real estate, find the right operator, and many times there's some no debt funds out there.
And now a couple of thoughts. Is this a deal killer? No, it's you just want to know that it's there. And we've got, again, another podcast talking about strategies of how to get around it. It's not smoke and mirrors, aggressive stuff. There's just different ways to deal with it. And really, you're looking at the overall net return in this fund. Hey, it's got a good management team. It's got a good track record. I've got some other buddies or gals or friends that are in on this. They've had a good experience. Okay. Now, in the prospectus or some Q&A, you might find out, oh, there might be a little UBIT or a little UDFI. Okay. Well, hey, overall return kicks butt. If the retirement account owes a little tax, the retirement account can pay that tax, and it can cover it in possibly the distributions, which is typical. So it's not the end of the world. You just want to be savvy enough to go, okay, there's some moving parts here.
Yeah. Let me give you another example. I had a client investing in a tech software startup, and it was an LLC. And so I was looking at this investment, and the company was raising money from it was a little fund. They were doing a raise of, I don't know, 10 million bucks, maybe, it's small for, Bay Area tech company. But but they stayed in LLC. They did not do a C-Corp. And the client's question was, well, am I going to have UBIT? And we looked at it, I said, well, what is the goal of this company? Well, my goal is that this company is going to take off, get a bunch of users, and some other big tech company is going to buy them out, and I'm going to sell all my shares and make profits. I'm like, okay, so your goal is to make capital gain income because this is a highly appreciating, hopefully, investment. Your goal is not to sit there and cash flow it as a partner in the LLC, getting ordinary income every year, is it? He's like, no. And in fact, they lose money for years. They get bought for tens, hundreds of millions of dollars, and they haven't even made a cent yet. So I'm never going to see ordinary income coming through on a K1, even if it is just an LLC. And so many times you want to look at the investment, if it's more in the startup or venture capital space, even if it is an LLC, you're not trying to cash flow the business and hold it as a business. Yeah. Your goal is it's going to sell to someone else or it's going to go public and you're going to get cashed out, and which is capital gain, which you would have no UBIT. So.
And see, what's hard here is I'm sure a lot of you are going, okay, that's cool, guys. I get it. How do I figure this out? I've got a day job. I work 60 hours a week. I don't have time to figure this crap out. So what's going to happen is, and I hate to say this, you might call your accountant and go, hey, I'm self-directing. It's a great idea. I like it. I vetted this. I vetted the company I'm investing in the fund. I love Directed IRA. They've been really supportive. Can you help me out with UBIT? And you hear crickets in the background. Yeah. Maybe even the person you called falls over in his chair and is passed out because they've never heard of UBIT. They don't know what UDFI is. They don't even know that you're self-directing or figured that out. That's very common. I'm a CPA. I'm a partner in an accounting firm. We do tax work around the country. I've worked at KPMG in the Big Five. Back it was Big Five. And so, but most accountants don't know this conversation. They don't. And they don't, and that's okay. It is a unique area. Doesn't mean your accountant's bad or dumb. But if your accountant, and that's the way I'd start out. Call up your accountant and go, do you know what UDFI is? Have you ever heard of self-directing? No. Okay, thanks. And then you want to reach out. And this is where our law firm, a sister company to Directed IRA, might be a big help. You might say, hey, I'd like to kind of know what the tax ramification of this project is. I know I'm going to do it. I got Directed IRA on the case. We're going to pull the trigger, loving it. But I needed some tax advice on what the ramifications might be. Cool. Retain a tax law firm for a couple hours. It's not going to be the end of the world, or an accounting firm that knows this, and say, will you look at this? What are my options? And you've listened to our podcast on how to get around UDFI or UBIT, and you're like, I just need some advice on if I'm going to have this and what to do, we're there for you. So we're not going to throw you to the wolves at Directed IRA, but you got to have a third party accounting or law firm.
Yeah, and we have a ton of resources too. And there's my book, the Self-Directed IRA Handbook, that's got a whole chapter on UBIT and UDFI. It's got a chapter on investing in such a good partner. It's got a chapter on investing in a private company where we flag some of these issues. So, but yeah, I think this is a growing area. If you look at the amount of money invested in what is quote unquote alternative assets, which basically means not big publicly traded companies, we're talking about small business and real estate and these private funds. This is one of the fastest growing categories out there that's actually seen amazing returns. And because the stock market just everybody just throws their money into it. But if you're really strategic and can find the good funds, can find the good small business opportunities, can find the good real estate deals, that's what self-directing is all about. And I see it from clients that, like if you, let's say you're I had a biotech client that used a Roth IRA in a really cool deal investing in a startup. They had it made multi-million dollar returns. But he was a doctor in that space. And he's like, this is a new company doing this cool thing. He invested his money in it. I had one even just a couple weeks ago. There's a mouthwash company that a client who's a dentist invested his retirement account into this startup that he's like, I know this is going to be the cool thing. And so they're seeing the opportunities in what they already know and investing into them at the ground level, not once the company goes public and, investors on Wall Street and the investment banks and everybody's already made a ton of money off of it. Now it goes out to everyone else to kind of like pick up the crumbs.
And let's talk resources here. For those that were on YouTube, I was playing around while Matt was talking. I'm holding up Matt's best-selling book, the #1 in the industry, with this new cover pointing out highest customer satisfaction survey on directed IRA services. This is the Self-Directed IRA Handbook. And it really is a handbook, people. Now, to buy the book, get over to SDIRA Handbook.com. Now, there's links at Directed IRA, but if you want to just check out the book, Matt's got some good videos there. Go to SD, as in Self-Directed IRA Handbook.com. Pick up a copy of the book. Also, a fun fact on this. The reason why I love what Matt's saying here is that you've got some insider knowledge in the industry. I'm not saying insider trading here. I'm saying you've got some inside knowledge on an industry, and you're going to invest in something you know. Oftentimes in these funds, you're getting double-digit returns, which is outperforming Wall Street dramatically in the S&P 500 because you're in on something that you know. Here's what's cool. You're building $1 million retirement accounts, multi-million-dollar retirement accounts. Get over to YouTube and type $1 million IRA, even throw in the word Kohler just to get there a little quicker. I'll be popped up in the top 2 to 3 videos. I've got 1 million views on a video on how to build a $1 million Roth IRA. And it all comes down to these double-digit returns. So check that video out. If you hit subscribe and hit the bell icon, every time I go live or have a video, you'll get a little ping and you'll just be like, But building $1 million Roth IRA is so doable. Guys, here's why don't you pool some of your family's Roth money, form an LLC, and then do the private fund investment? See, some people are like, well, Mark, that's nice if I had a $250,000 Roth. Well, maybe you do if you pooled you and your spouses and your kids' Roths, formed an LLC. Now you can get a $250,000 position in a fund through an LLC owned by 7 Roth IRAs.
Yeah.
Never pay tax on it. Matt?
Yeah.
Blew out of the water there.
If you didn't know what Mark was talking about, we did the multi-member IRA LLC. That's that structure's called a couple podcast episodes ago about the IRA LLC. And if you're also like, guys, how do I even get a self-directed account? I've just stumbled into this podcast episode. Go back to episode 1 here. And we've kind of started in order here of like easy to complex. So we're already at kind of the different investment types here. So, and private companies and funds being one of them. Again, do your due diligence on them. But invest in the things that you know. That's what self-directing is all about. Don't give up and just buy, boring stuff on Wall Street and just kind of like, put it in a mutual fund. You don't even know what the heck is in it. Just be more engaged with your money. I think that's the best advice for any of us out there, no matter what we're doing.
And this is fun. This is like a rabbit hole. I've had clients go, Oh my gosh, you said self-directing, and then I got Matt's book, and I've been like on a roller coaster for 3 weeks, learning and not even know. I never knew this world existed.
Yeah.
The Merrill Lynch's and the Oppenheimers and the Smith Barneys, they don't want you to know about this because you're going to take the money, pull it out of your old 401k or your old IRA and go, oh my gosh, I can self-direct this and invest in what I freaking know. Oh my gosh. Now this whole new world's opened up to you, and it's exciting and it's legit. There's millions, billions of dollars in self-directing out there, and it's been there for years. And it's just, we can't afford a Super Bowl commercial. And so we can't compete against Merrill Lynch to let you know about it. So you've stumbled upon us. Soak it up. Subscribe. Give us 5 stars if this blows your mind. Please give us a good rating. That way more people can hear about this.
Yeah.
Love it.
Yeah. Of course, you can always learn more about the podcast too at directedira.com/podcast. We're on all the channels. You can find the video on YouTube if you're listening and you want to kind of see, the video. It's not that exciting. It's just Mark and I's faces, but Well,
no, you're going to see some tan, good-looking guy here in Idaho where it's 3 degrees, and some pasty white guy in Phoenix.
I was just thinking that, man, I don't know if I got the lighting wrong or what, but I'm like looking pretty pasty white compared to you.
No, hey, Matt is a good-looking guy. He got a new haircut today. He looks quite
yesterday.
Quite may say. Was it yesterday? Yeah, you're looking good.
It was 2 days ago, actually, but it's looking fresh.
See, put your hand up like that. Do that. Do that one more time. Okay, now, see, you saw the Matt's tan come out when his hand, see, it's the webcam. See, right there, see, there was a little bit of
camera tricks.
Yeah, the camera picked it up. Matt, you got all the, you got all the pieces and parts, but you're the Full Metal Jacket, the real deal. I don't know what you say. You're a stud.
Well, I appreciate the confidence boost.
Yeah.
All right. Well, thanks everybody for hanging in there on the podcast. We appreciate being on here. Hopefully you're finding this to be helpful. We'll be back next week. We're actually talk about, there's 2 upcoming topics about how to start your own business with a retirement account. Pretty complicated strategy, but there are some options there. We'll walk through them. And then we're going to start doing open forum too on the podcast as well. We're fielding a lot of your your self-directed IRA questions on what you can and can't do and some of the cool things people are doing. So
which are tax related. We got to talk about OJ Simpsonizing your retirement.
We got to talk about the asset protection of your retirement accounts.
Yeah. And we do hope by the time open forum hits, there'll be a little comment section where you can leave your question and get some community there. People can comment. We're going to reply. We'll let you know what episode we commented on the question and maybe say a few words. We've got 6 attorneys in our law firm that can take a call anytime, make an appointment, and get a little consult and learn more about this. So that's the beauty of this. We've got the sister law firm and the sister accounting firm that you can go to as resources if you need it. So again, don't be dismayed if your professional is not up to speed on this. Some aren't. Yeah. But we got those firms if you need it. And thanks, everybody.